This is the third presentation in our module Theory of Production. Now, here we are going to discuss the various concepts of revenue and cost. Basically, these are introductory in nature, introductory lecture, which will talk about only the basic concepts of revenue and cost. And you need to study this thoroughly, you need to understand these concepts thoroughly, because you have to solve various case studies later in the class and for the examinations also. Okay, so a good understanding of revenue and the cost concepts will help you to answer many of the case studies, right? These are not very complicated, simple things only, but you need to focus and study. Many of the things we have studied in the previous year and previous semester in the financial management subject. Now, revenue. Revenue is the income of the firm which they sell, which they gain after deducting all the taxes and other expenses. Okay. Revenue provide the income which the firm needs to enable it to cover the cost of production and from which it can derive profit. So, revenue means the total collection before deducting the cost of production. And from revenue, when you deduct cost, you get what? You get profit. Profit is distributed to owners, shareholders, or retained in the business. You can do two things with the profit. One is that you can give it back to the owners or probably the shareholders if it is a limited company, or it can be retained in the business. We call it as retained earnings. And why do we retain this? To purchase new capital asset or to upgrade technology or for investment, further investment or reinvestment purposes, we can retain the profit. And there are three concepts of the term revenue. One is total revenue, average revenue, and marginal revenue. Total revenue is the total income flow, total flow of income to the business. We said earlier about total product. That is 2000 kilogram of output from a farm, of 2000 kilograms of wheat output from a farm. That is 2000 was the total product. Similarly, the total money that earned by the business by making sales is called total revenue. Average revenue is nothing but the total quantity, the total revenue divided by the quantity sold. Total revenue divided by the quantity, we get average revenue. Marginal revenue is revenue generated from selling one extra unit, one more unit of, if you decide to produce one more extra unit and to sell, what is the revenue that you get from the extra additional unit? That is called marginal revenue. I hope you remember the concept we have studied in break-even point. We learned break-even point. We studied about marginal cost, the cost of producing and selling one more additional unit. So, marginal revenue is the revenue you get from selling one more additional unit. That is called marginal revenue. So, there's an example here, right? So, when the price was rupees 10, you could sell one unit. Therefore, total revenue is 10 into 1, that is equal to 10. And when you reduce the price from 10 to 9, you could sell two quantities. Therefore, total revenue is 9 into 2, that is equal to 18. Therefore, marginal revenue is 18 minus 10, that is equal to 8. So, when the price changed from 9 to 8 and from 8 to 7, 7 to 6 and so on, the quantity sold increased proportionately and there is a change in the total revenue also, right? So, if you look at total revenue, it increased until this particular level. After that, it remained constant. Then after that, it started declining. So, here it is declining. This is constant and here actually the TR is increasing. Right. Now, this is more visible in the marginal revenue column. This is actually visible here. So, 864. So, it is steeply declining. Right. Now, if you plot this particular thing in a graph, we will get a graph like this. right? This graph I have put it as a bigger picture in the next slide. We'll just go to that. Now, this slide will help you to understand the behavior of various curves, revenue curves. Total revenue curve goes upwards, it reaches a saturation stage and starts decline. Total revenue will decline like this. Then we have got two important revenue curves, that is AR and MR revenue. Average revenue is TR divided by quantity sold, that is average revenue, right? This is nothing but selling price per unit, average selling price per unit. And this is the revenue from sale of additional unit, right? Now, as we want to increase, hope you remember what we studied in law of demand. As you reduce the price, you will be able to sell more and more quantity. Therefore, the average revenue, we have to reduce the price to sell more quantity. Therefore, the average revenue, that is nothing but the average selling price, will be declining. It will decline like this, right? And similarly, marginal revenue is also there. Marginal revenue will decrease. It will also decrease, but it will decrease at a more steeper rate. That is what you need to remember. There's a difference between MR curve and AR curve. MR curve will decline much faster than AR curve. Both the curves will decline, but MR curve will decline faster than AR curve. Okay. Now, that's with regard to revenue curves. That's a very brief one. And let us come to the cost curves. What about cost associated with the production? Now, these are the various types of cost. We have studied some of this in the last semester. I have made a list of 12 different classifications of cost. Now, this is a homework for you. What you need to do is, you need to write down the meaning of each of these 12 types of cost. That is future and past cost, incremental sunk cost, out of pocket and book cost. So you have to find out the difference between all these 12 different types of cost, and you have to do it today and upload it today itself. These are the various types of cost. Okay. And also you need to do this one. Only when you do the previous activity, you will be able to do this particular activity. Now, some examples are given. You have to identify to which category of cost this belongs to. For example, you paid for office stationery. What kind of a cost is that? That is, there is an interest cost on owner's capital. The owner has contributed capital to the business, and he is charging interest for that capital from the business. So, what kind of a cost is that? When you buy a machinery, right, what kind of a cost is that? In 1980, you have purchased it, and currently it is worth rupees 50 lakhs. So what kind of a cost is this rupees 2 lakhs? Okay. Now you have paid salary to administrative personnel. You have paid salary to the owner of the company. So what kind of cost is this? You have to explain it with the help of the learning in the previous slide. Therefore, doing the activity and understanding the different types of cost in the previous slide is important to do this particular activity. Otherwise, you will never be able to do this particular activity. So please be serious with this particular activity. You do both the activity and upload it today. Okay. Now, short-run cost curves. Right now, here we are going to learn the behavior of various cost curves. And to draw the curve, first we need a table, we need data, right? Now, output, rate of output 1, 2, 3, 4, 5, 6, 7, 8, 11. So this column gives you the output. And fixed cost. So this is nothing but the quantity, right? Quantity. And this is fixed cost. Fixed cost, it is same all the cases. Why? Because fixed cost will remain stable at all the levels of output in the short period. Variable cost, whether it is short period or long period, the variable cost will always vary. What about total cost? Total cost is fixed cost plus variable cost is called the total cost. That is, if you add fixed and variable cost together, you will get total cost. What about marginal cost? Marginal cost is the incremental cost. When you added one more output, so what happened? that is marginal cost. Okay, so you can see here marginal cost, here the output total cost is 100 and here the marginal cost was 50. So total cost is 50, therefore marginal cost is 100 minus 50 is 50. Here it is 128 minus 100, that is equal to 28. So marginal cost is difference between the total cost, right? What about average fixed cost, AFC? So this AFC, AVC and ATC will be the more important terms for solving the case studies. So you need to focus more on these three concepts. AFC, average fixed cost is, average fixed cost is total fixed cost, that is 50 divided by the rate of output. So here it is 50 divided by 1, that is equal to 50. What about average variable cost? Average variable cost is, so here variable cost is 50 divided by 1 unit, that you will get again 50. Total, average total cost is 100 by 1, that is equal to 100. Okay. Now how do you get this 25? 25 is, here the fixed cost is how much? 50, because at all levels is 50. Number of units produced is 2. So 50 divided by 2, that is equal to 25. Now what about variable cost? Variable cost right now is 78 rupees. When you increase the production, the cost increase, not proportionally, but still it varies. So 78 divided by 2, that is equal to 39. Therefore, average total cost is, you can do it two ways, either 128 divided by 2, or you can simply add these two things, average fixed cost and average variable cost, and you will arrive at this one, right? So this is how we calculate fixed cost, variable cost, total cost, marginal cost, AFC, AVC and ATC. Okay, so this last 4 columns are very important for our examination and other purposes. Okay. Now, those things I told you about last 4 columns. All the data given in the last 4 columns are given in the graph to the right. All other things given in the left side columns. So you can look at the behavior of this particular graph. Now, this is rather simple, so let us focus on this one. Okay. Now, what about the behavior of average cost curve? Average cost curve is U-shaped. Average cost curve is U-shaped. Now, initially it was very high. As the output increased, it declined, and there is a minimum point. And after a minimum point, average cost will start increasing. This is true in all the cases. In all the cases, this is true. Now, what about average fixed cost? Fixed cost is increasing, it will continuously decline. It will continuously decline. So from here, as the output increased, average fixed cost will continuously decline. What about average variable cost? Average variable cost is initially high, but it declined, but later it started to increase. So as the output increases, the cost will increase. That is, if you increase the output beyond a point, the average cost will increase. Right. Now, what about marginal cost? So the most peculiar behavior is that of marginal cost curve. Why? It was the lowest at the initial stage. When we started production, marginal cost was very low only at this particular point. And as we increase the production, it's further declined. It further declined. Now, after a certain level of output, what happened is, it started to shoot up like anything, and it started to increase, and it started intersecting average cost curve also. At what point? This point is important. You need to note this. Marginal cost curve intersects average cost curve at the minimum point. Okay, at this particular point, marginal cost curve intersects average cost curve. This point is important that we will discuss in later in the next module. Okay. So this is the behavior of marginal cost curve. So right now, I just want you to understand the behavior of various cost curve, especially the average cost curve, average fixed cost curve, and more importantly, the marginal cost curve. Average cost curve is U-shaped. Average fixed cost continuously declines. Marginal cost actually very low. It still declines, but after a certain point, it starts increasing steeply, and it intersects average cost curve at a minimum point, at the point where average cost is very low. Now, this is a presentation. This is a video I have downloaded from Khan Academy, no, not Khan Academy, from YouTube, and this will be a very useful one which explains the behavior of cost curves. Okay, so you need to go, you click inside this and you have to go through the video, right?
Previous video, I showed you the per unit cost curve. We've got average fixed cost, average variable cost, average total cost, and margin.
Now, whatever you have seen the previous video that is explained here, so I'm not going to explain this again. Okay, so the peculiarity of various cost curves are explained here. Now you need to remember one important term here, asymptotically. It means what? Asymptote means it declines. For example, you need to just recall the shape of average fixed cost curve. It was declining like this. It was declining. But did it touch x-axis? No, it will never touch x-axis. It will give you a feeling also it is going to touch x-axis, it is going to become zero, but it will never become zero. It will continuously decline and go on, keep on going like that. That nature of a line is called asymptotically or asymptote line. Okay. Now, long run cost curves. So we have seen short run cost curves so far. Now we are going to talk about long run cost curve. Okay. Now this is again explained with the help of a video in the next slide. When you go to the next slide, you will find another video explain this. But let me tell you, say I told you AC curve, average cost curve has got a U shape. You might remember from the previous slide. So average cost curve is having a U shape, and marginal cost curve intersects it at the middle. So this is marginal cost curve, and you also have seen average fixed cost curve, AFC curve. I hope you remember all this, right? Average fixed cost curve, then all those things. This is average variable cost, ABC curve, right? All these curves you might remember, right? Now, now let us come back and let us see what happens in the long run. Say these are all average cost curve. This is, we say, short-term average cost curve. And later, as we try to increase the production, you will have another average short-term cost curve, and you will be experiencing different average cost curves, short-term average cost curves. When you have in the long run, over a period of time, this is called long run. So maybe 1 year, 2 year, maybe 10 years, in a long period. What happens is that you will find you will have multiple average cost curves. When you join the lowest points of all these cost curves, average cost curve, short-term average cost curves, you will get a big umbrella like cost curve, that is called long run average cost curve. Long run average cost curve is a combination of different average, short-term average cost curves. Okay, so you can understand this concept a little better in the video which is going to the next slide.
We've talked about the idea of average total cost in several videos.